All right, everyone. Thank you again for joining tonight. My name is Alex Navarro. I am an associate broker at Metropolitan Boston Real Estate here in Somerville. I cover a wide area throughout Greater Boston and really love to educate buyers on lots of different topics. And tonight I've asked my good friends and partners, Brian and Caleb, to talk to you a bit about non-QM loans. They have a combined 30 years of experience. I've worked with them on dozens of properties, and Brian actually helped me buy my first house when I was not even an agent. So I've been working with him for a long time, and I'm really excited to have him and Caleb here tonight. And with that, the floor is yours, guys.
All right. All right. Thanks for having us, Alex. And just a quick testimonial. If you guys are in the real estate market and looking for an agent, Alex is exceptional. In my position over the years, I've worked with thousands of different agents, and extremely knowledgeable, communicative, and true all-star. So if you want to flip that page, Caleb. So I don't know, as mortgage people, we like to throw out acronyms and a lot of terms. And, a lot of times we expect our real estate partners and our borrowers to understand what we're talking about. And here's just a smorgasbord of them. And during this presentation, hopefully we'll provide some clarity on some of them. But if you catch me throwing a bunch of letters out, and you don't know what I'm talking about, just interrupt and pause and go over that. So but here's some of the some of those letters that we'll be addressing during the presentation. So before we talk about non-QM loans, I think it's important basically to show you what a qualified mortgage is. So this is a term we didn't have until about 2010. And it was following the mortgage crisis, the financial crisis of 2007, 2008. And leading up to that time, we had very flexible lending rules, a lot of subprime loans with very little documentation, low down payments, basically a little bit risky. So if you were to go to the Consumer Finance Protection Bureau, their website, you'll find this definition on there. Basically, after that the housing crisis, the meltdown, there was a lot of regulation, and the government basically said you can do this type of loan. They basically put a definition on it. But one of the good things that came out of that regulation was basically putting the responsibility on the lender to prove that the borrower has the ability to repay the loan that we were providing. So, for a number of years following the housing crisis, that's essentially all we could do. If you didn't fit into a qualified mortgage, you were kind of out of luck. And so some of the attributes, if you want to flip that, of a qualified mortgage is basically, full documentation, traditional documentation. So it's going to be a good fit for your traditional wage earner, somebody that gets regular pay stubs, a W-2, or if you're self-employed, we're going to look at 2 years of tax returns typically, and we're really going to comb through all of that documentation and figure out what we can use for income. And these safer loans are typically securitized and sold through Fannie Mae and Freddie Mac, or if it's an FHA or a VA loan, Ginnie Mae, which is basically the entities that buy these loans from banks so that we can go out and lend more. The debt to income ratio for a qualified mortgage a lot of times is about 43%, which is pretty tight. And so I guess the question is, like, what if you do not fit into these standard guidelines? What if your tax returns don't tell a good story? And that's where this non-QM programs are more flexible. So they offer more options for non-traditional borrowers. But more importantly, it kind of adds flexibility to how a lender basically satisfies that ability to repay loans. So we are still going to get documentation and look at those, but we have a different means to approach that income calculation. And I don't know if you've ever seen, any of you have seen the movie The Big Short with Steve Carell. At one point, he goes down to Florida, and this is in the middle, the height of like the housing, craziness. And he asked the loan officers, "Have what happens if the borrowers don't qualify?" And they just started hysterically laughing because at that point there were programs. You had your, we call it ninja loans, which was no income, no job, or no income, no asset. We basically had a program for anybody. So these new products, these non-QMs, are not irresponsible lending like that. It just gives us more flexibility in kind of how we approach qualifying buyers.
I have a quick question that's related to the transition from qualified to non-qualified. Have the rules for qualified mortgages changed over the years throughout your career, Brian?
I think they've yes and no. I think I think over time lenders have been a little bit. There's a lot of times where there's some subjectivity to a file, and I think right after the housing crisis and for several years after, it was a very, the pendulum had swung and it was very, very conservative. Now I think as lenders, we're trying to find ways to fit people into those QM programs. And the other thing is like if we're doing a conforming loan, and a conforming loan means that it fits the guidelines set by Fannie Mae and Freddie Mac. We're running it through their underwriting engine. So we submit that file, and Fannie Mae and Freddie Mac will respond yes or no, essentially. And sometimes we'll get approvals over and above that 43% debt to income ratio. Not always, but sometimes we will get an approval that goes, if you have really good credit and reserves, we'll get those approved up to maybe 50%. A lot of jumbo programs are non-conforming. It's basically just larger loan sizes are still going to be very restrictive and have less of them have flexibility to go above that 43%. So it is still a very vanilla, we're looking for vanilla borrowers for these, but maybe we are a little bit more aggressive in how we underwrite those programs. And so I'll just turn the wheel over to Caleb here and talk about some different programs.
Yeah, thanks, Brian. So, yeah, on this webinar, we want to give everyone an overview of essentially 3 programs. These are going to be the most common and the most powerful options within the non-QM space. And hopefully you can be better informed about what's out there and what might make sense for your situation. As Alex did, if you guys really pay attention, you can pepper Brian with questions at the end, so we're not just giving you guys a lecture. So the 3 programs that we'll be focusing on today are bank statement loans, DSCR, and asset-based qualifying. Each of these programs is unique, and they're uniquely suited to the individual borrower. And they can provide some benefits that a traditional loan might not. So first, what is a bank statement loan and who is it for? When qualifying for a bank statement program, typically this will be a self-employed borrower whose tax returns don't tell the right story on their income. And I'll share an example of what that actually means in a few slides. But self-employed borrowers are still generally required to have a 2-year work history, but they have the option to provide us with 12 months or a full 24 months of bank statements for us to do their income calculation. So when those statements are received, what we look at are the total deposits that are related to the business. And then skipping down to this final bullet point, there's going to be an expense factor applied to those deposits. And this is the key in how we determine your qualifying income. The standard is going to be simply a 50% factor, meaning if you bring in $20,000 a month in revenue in sales for your business, you can use 10,000 of that as your qualifying income without having to calculate what your exact expenses are for the business.
And
So
Caleb, is that before or after tax?
So that is the beauty of it. So with the bank statement, one of the aims of it is to avoid having to look at tax returns. So the example that I'm about to go through will be a real example that we had with the borrower last year, whose tax returns had who had a lot of write-offs, a lot of deductions, which limited their qualifying income. Whereas with the bank statement loan, you're right. It's before tax. It's looking literally at what amount is deposited in your bank account and applying the factor to that. So this was the borrower that we had worked with, a snippet of their example. They were Schedule C, so they ran an LLC, and they wanted to buy a primary home, but they only had about 20% to put down. Like I mentioned, their tax returns weren't helping them. They were punishing them when applying for a home loan. These are their numbers, just to give you an idea. I've rounded them a little bit to make them look prettier. But they were trying to decide between a single family home and a multifamily and wanted to be right near $1 million purchase price in the case of a single family home, which they did end up buying. Now, like I mentioned earlier, we can apply this standard expense factor to the deposit. So these borrowers had $40,000 in monthly revenue, which showed on their business bank statements. And that turned into $20,000 in qualifying income versus a traditional income calculation, which factors in all the write-offs, which was only giving us about $7,500 to $7,800 for their income. So Brian and I and Alex are all in the greater Boston area. I think it's a very easy case to explain how impactful this program can be in any high cost of living area. So for these borrowers in particular, they bought the $1 million home that they were seeking, which would have been impossible under traditional guidelines. They would have been stuck at about half of that. Before I turn it back over to Brian, I just want to show how we actually got there. So tax returns can either be your enemy or your friend when applying for a loan. And in the case of self-employed borrowers, 1099s, it's more than often your enemy. So in this scenario, which is different from the one I just showed you, we can see the two important numbers at play. The gap here is going to be between the gross sales, this top arrow here, and then at the bottom on line 31, that's going to be their listed profit on their Schedule C return. So while a standard underwriter would use the net profit on a traditional loan, giving us about $6,700 a month to work with, a bank statement option could more than double or triple their income, which drastically increases their buying power. So wrapping up this piece, Brian let us know in the opening slides that a qualified mortgage will have a DTI, a debt to income ratio, try not to use the jargon, below 43%. So you can see under a traditional income calculation, the borrower would be ineligible to buy this house. But a bank statement calculation gives them the option to expand their budget without letting the write-offs and deductions pull it down. So now I'm excited about this second product, which I'll hand off to Brian. I believe we did more DSCR loans for investors last year than any other non-QM product. So with that, I'll give the floor back to Brian.
Yeah, and before we move on, if anybody has questions about the bank statement program,
yeah, absolutely.
If not, we'll jump into the DSCR. Actually, Caleb, if you could just explain why would the difference between, say, a 15% expense factor and a 50% expense factor?
Great question. So this is on a couple of different slides. So I will I'll leave it here for now and we can kind of flip through things. So when I say standard expense factor, I'm just saying that is with no paperwork, with no extra work, we're able to use that number and take your revenue and cut it in half to give you your income. That's the 50%. But Brian makes a good point. We can get that number down to as low as 15%, where we're only simulating about 15, we're only knocking off about 15% of the revenue that comes in. Now, the way that that happens is when looking at your business, there will be a number of factors that can influence that, be it the number of employees, the type of business that you are in. There's a number of areas that can lower that. And we can supplement that with a CPA letter as well to determine what the actual expenses are, to kind of fine tune a number between 15 and 50%. So that's where it gets a little more complicated with the different options. But if 50% doesn't work, then we have the ability to fight for a more aggressive expense factor.
Good stuff.
Does anybody else have any questions on the bank statements? Or we can also cover those at the end if they don't at this point.
Perfect. All right, we'll move on to the DSCR, which is the debt service coverage ratio loan. As Caleb mentioned, this is where the majority of non-QM programs, about 50%, and this is industry-wide, about 50% of non-QM is falling under this DSCR product. It only works for investment properties. Basically, what we're doing is looking at the rental income for the subject property and comparing that to the monthly payment. So if the monthly payment on the property is $4,000, ideally, we would have a rental income equal to that or more. Ideally, more if you're buying the property. And these are great for investors that might own multiple properties. The more properties you own, the more complex your tax returns get, and the more write-offs, and it really becomes more challenging to qualify once you start layering in multiple investment properties, and nearly impossible once you reach a certain level to get it into a QM product type. So you can move that next slide. So I think I coined this phrase commercial light, because the way we're approaching qualifying is more similar to like a commercial type property or commercial underwriting analysis, which again, we're looking more focused on the rental income that the property's generating against the monthly payments. Now, in a commercial loan, they're looking at the rents, but they're also applying a lot of expense factors like a management fee and vacancy factors. So it's harder, more challenging to reach what they want to see is really 1.25%. So what often happens in a commercial loan environment is that the seller has to reduce the sale price, or the buyer has to increase down payment in order to hit that 1.25. So the commercial light is basically we're applying some of the same, the thought process behind it, but it's for residential properties. So typically 1 to 4 unit properties, and we have a target ideally of just 1. 1.25 is great, but most DSCR programs are happy with a 1-to-1 ratio. In the rents, if the property is not currently leased, if it's a purchase, the rents are going to be determined by the appraiser. So when they go out and they evaluate the property, not only are they comparing that property to against what other properties have sold for, just as far as the price goes, but they're also doing a workup of what, say, a 2-bedroom, 1-bathroom apartment in Malden is going to generate for income each month. And what's great, again, is this is a perfect program for somebody that owns multiple properties, because there's less documentation and there's really no limit where, your standard QM programs, some will limit you to 4 finance properties. Fannie Mae limits you to 10. So once you start building a portfolio that exceeds those, this is a great space for you to be in. You can flip the Caleb. And here's an example of one that we did about, I don't know, 3 or 4 months ago in Revere. It was either Revere or Everett.
It was Everett.
Everett. So
Mhm.
we had so it was a 4 unit property. It was a purchase, and this borrower it also happened to be self-employed. So trying to use the tax returns to make it work in a traditional QM program, we weren't even close. And if we tried to go the bank statement route, which might have worked, it would have been a lot of additional paperwork to gather the bank statements, add up all those deposits, apply that expense factor. So this was really, the best option, not just because it was the path of least resistance, but the terms were very good as well. So it was a 25% down payment on a $1.2 million purchase. The total mortgage payment on a $900,000 loan, so the principal and interest, the taxes and insurance, was roughly $7,500. The market rents from totaling up the 4 units was actually $9,600. So this was like, I would say a really good investment for the buyer, because that debt income, I'm sorry, the debt service coverage ratio was well over the 1%, actually over 1.25. So it came to like 1.28. So this was a breeze through underwriting because the rents were so strong. Now, if you see on the right side of this slide, this is a snippet of the appraisal. This was the 4 rents from the 4 units, which totaled the 9,600, and none of them were leased. So this was the appraiser's opinion. And this is where, like, if you're going to use a program like this, before making the offer, it's always good, if you're working with Alex, check with him to see, what he can do, basically some comps on not just what the properties are selling for, but also what they're renting for. So before you get too far in, to make sure that the rents are hopefully going to cover. Now, if we don't have a 1-to-1 ratio, it's not always the end of the world. We do offer programs that go as low as like 75.75, which means the mortgage payment's actually higher than the rents. Usually, if we're doing that, we might want to see some additional reserves. And it's got to make sense for you too. If the rents aren't covering the mortgage, there might be something else that's drawing you to that property, because ultimately you want to make money on a rental property. But there may be some other benefits to owning that particular place if it's not covering it. But yeah, again, 1% debt service coverage is great, but potentially we can even go lower at times. Anybody have any questions on how that works? All right, you want to shift gears to the next
Yeah,
one?
I've got before we go on, I
Yeah.
have one question for you, Brian. So if that ratio is close, right? Like we're almost hitting the 1%, it makes sense to buy this property, or the buyer wants to buy it. But just because interest rates are higher right now, the numbers are close but not quite there. Are there vehicles that they could pursue, different loan types, longer term, interest only, that might make it work to get them into the loan?
Yeah, that was kind of a layup. So with non-QM programs, I mean, we're talking about 3 specific products, but there's all these different options within there. One of them that works really well is an interest-only feature, or think of it as a paradigm shift, as a principal optional loan. So it might be a 30-year fixed loan, but the first 10 years will give you the ability of making a minimum interest-only payment. So if it's tight, and you wanted to reduce the monthly payment, it would really be interest, tax, and insurance. We can do the DSCR calculation on the interest, tax, and insurance, which is going to result in a lower monthly payment compared to the PITI. So that's that would probably be the first thing that we look at, and it doesn't always have to be a 30-year fix. Sometimes ARM programs will offer a little bit of a lower rate as well. So we would go through, we're basically just trying to solve for whatever weakness there is. And these non-QM programs give us a lot of levers to pull on to make things work.
Awesome. Thanks.
Thanks, Brian. This is not a comment about a non-QM loan, but just you made me think about calculating rents for home buyers. Very common when searching for owner-occupant properties. So if you're looking to live in a multifamily and make that purchase, you need to calculate those rents. So your agent's going to help you do that. Your lender's going to use that number, and then eventually the appraiser is going to give their opinion on what you all thought about that.
Mhm. So the last program that we're going to talk about is just kind of an asset-based method of qualifying. Basically, with this program, what we're trying to do is take somebody that has significant assets, but not a lot of income, and we're basically trying to convert those assets into income. And it's really suitable for somebody somebody who's recently retired, who might have Social Security and they're sitting on their retirement funds, but their required minimum distributions plus the Social Security is just not sufficient enough to do what they want to do. And with these programs, typically looking for total assets over $1 million. But we do have times where we can go as low as 500,000. So I'll tell you a little bit. This was a kind of a cool story of a client that I helped. I really started working. It's been a client of mine for probably 15 years or so. And the most recent loan we did was about 10 years ago. And it put them in a 10-year arm because they were going to retire. And we knew that 10 years was going to be more than enough time. Their kids were, I don't know, in junior high at the time. So that was going to get them way through high school. Anyways, during the beginning of COVID, while they were still working, they purchased a second home down the Cape. They had this vision of going down the Cape, staying there year round, basically, but they also had this sailboat. So they were basically going to split time between the Cape, and then they were going to sail the boat down into the Caribbean and spend the winters there. Life took a turn for them because their kids didn't leave their house in Medford. So they were stuck with two mortgages. Now he's not working anymore. She's been retired for a few years. And just kind of bad timing. It was a great program for them, that 10-year arm that they had, but it was set to adjust. It was adjusting in the middle of 2000, I think it was October 2023. And that was going up. The rate was going from 2.875 to 7.875. And it was changing from basically you got to repay that loan for the remainder of the remainder of the 20 years on that 30-year loan. So their payment was going through the roof. And we needed something that was more sustainable because they needed more time. They weren't ready to kick the kids out. So we were able to make it work by using just they had the Social Security income, but we had to use the assets to get it done. And we did also, in this particular case, complement the loan with another 10-year interest only feature because they will be out of there eventually, but it was more just about the cash flow. They weren't really concerned with paying it down. But this program, I'll let Caleb walk you through the math of it. But this really saved them.
Yeah.
Quick
So
question for you guys. Sorry, Caleb. When you listed assets all as basically liquid assets, does real estate count as an asset, equity in real estate?
Not for this particular program. Basically, as what we want to know is that you can get your hands on that money without talking to somebody like me and going through
Fair
the
enough.
refinance process. So,
yeah, great question. So this screen here shows the exact numbers on the deal that Brian and I worked on last fall. And I think it gives a perfect picture of the whole program because it addresses almost every scenario that you'll see within it. And then I also just wanted to point out, Brian just mentioned it, all of these programs, they make sense for purchasing a home, but they can also make sense for refinancing if it's the right scenario. It's not one or the other. They're available for both. But this borrower had $850,000 in a retirement account, just over $1 million in a brokerage account, and around 100,000 between their checking and savings accounts. And in asset qualifying, we can use all of these funds, but they're treated a bit differently. So with the checking and savings accounts, we're able to use 100% of the funds in our income calculation because, as Brian was alluding to, you can access that money at any time. It's not locked up at all. There's not going to be any sort of restrictions on it. It's sitting right there for you to withdraw at any point. Brokerage funds, you can still use most of, but there is a slight cap applied because these are primarily stocks, exchange traded funds, different investment vehicles, which could fluctuate in value before your loan closes. Because remember, we're not selling these assets to qualify. We're looking at today's balance to estimate how much of a payment you could cover if you had to draw from those funds down the line. So that brokerage balance is going to be reduced by 20% for what you can use for your qualifying income. Retirement funds, they had 850,000 in retirement. They're treated largely the same way, just with a slightly more aggressive cap of 30%, meaning you can use 70% of those funds in qualifying. The way we get to the magic number on the right of available income is by taking the usable assets, so applying the 80% or 70% factor and dividing them over 84 months, which shows you how much of a payment you could make if you needed to draw from these sources for 7 years, 84 months. So this borrower's $2.2 million in assets turned into $20,000 in available monthly income that we could then tack on to their existing Social Security income, which was only about $2,000 a month. Slide got stuck there. And that was the math for that situation. Before we conclude, I'll put it back on that screen. Does anybody have any questions on the asset qualifying?
I think, yeah, like you clarified, this situation could have been the reverse, where they had their primary residence and they've always dreamed of having a second home. Not that they already had both and they had to figure out a way to keep them. But if they wanted to buy a ski home or a place down in Florida or something, it's really hard to do when you're on a fixed income with Social Security, maybe a small pension, when you're layering in additional mortgage payments. So I think more often than not, this particular program is used probably to purchase. But again, it's, with any of these refinances, sometimes it's for cash out if to buy another property or do other things. But you have different applications for them. And with any of these, we're basically just trying to solve for weaknesses and how do we make the numbers work using the resources that the borrower has.
So in conclusion, we spent some time briefly covering each of these topics, right? So bank statement solutions for self-employed borrowers, DSCR loans targeting real estate investors, and asset-based lending for the term that Brian likes to use is cash rich but income poor individuals. Each of these programs are so important for clients who may not fit cleanly into traditional guidelines. So I would encourage everyone to ask questions if they want to unmute themselves or put something in the chat. I can't see it right now. It looks like there is. I don't know if there's a question or.
That was just me. I was just welcoming a latecomer, Jessica.
Oh, perfect.
Yeah. Jessica, in particular, do you have any questions about the first loan product? If you want to go back to that screen for a second, Caleb.
Sure, yeah.
Just I think that was the one that you missed. And
Putting her on the spot.
Thank you for that. I'm sorry for joining late.
no problem. This is one I think that most people coming here might be curious about, so that's why I wanted to make sure. Are you self-employed?
I am part-time employed, and my
Gotcha.
husband is a contractor. So we've both gotten into this year, we've both gotten into that weird world, coming from previously both being full-time employees.
W-2, yeah. So this could be a program that might work for you both, based on, running your own business. Lorianne had a question that was, what is the interest rate for the bank statement program? Or I guess, what would be the difference between a QM and a non-QM?
Yeah. So these will have slightly higher interest rates. If it depends on a number of factors, but like if we're using, say, a standard 20% down option, and the credit scores are equal, I think the interest rate on average is probably about 0.5% higher. And the higher you go with loan to value, meaning the less money you put down, that spread might actually be a little bit wider than 0.5%. But yeah, generally speaking, somewhere around about 0.5.
Makes sense. You're not fitting into the usual box, and there's a little bit more risk for the person who's going to eventually own that loan, or not the person, but the entity.
Yeah.
So that's totally understandable, but it's a great way to get so many people, myself included, into a loan product that works for them.
Sure.
Lorianne, could you clarify it? 50% more?
I'm sorry, I am like starting to learn all these terms and like all the steps that you have to take. So he said the interest rate will be like 50% more than.
No, just 0.5 percentage point.
Oh,
So if
half.
the rate,
Okay.
if the average rate today was 6.75, it might be 7.25 for a non-Q.
Okay.
Yeah.
Okay. Okay, I understand.
Yeah, good question.
Thank you.
Are there any other questions this evening for Brian and Caleb? All right. Well, gentlemen, thank you so much for your time.
Yeah.
I learned a lot tonight and really enjoyed doing this. I hope we can do more sessions like this. If you guys do have any questions for Brian, for Caleb, their information is on here, but I will also be emailing all of you all of our contact methods, and I'll CC these guys so we can all stay in touch and be of service whenever you need us.
Awesome. Thanks, Alex.
Awesome.
Nice
Thank you, guys.
meeting everybody. Have a great night.